January 9th. That's today. And if you're holding silver right now, or if you've been watching it from the sidelines thinking you have time to decide, you need to understand something critical. What's unfolding in the next few hours and days isn't just another price swing. It's a structural shift that most retail investors won't see coming until it's already too late. The signs have been there for months, but today marks a turning point that could redefine how silver moves for the rest of this year and beyond. So if you think you're prepared, I'm going to challenge that assumption right now. Before we go any further, if you're serious about understanding what's really happening with precious metals, the dollar, and the financial system that affects your wealth every single day, make sure you're subscribed to the Wealth Continuum. We break down the macro trends that matter without the hype, without the noise, just the information you need to make better decisions. Hit that subscribe button now because what we're covering today is exactly why this channel exists. Let's start with what most people are missing. Silver has been called the poor man's gold for decades, and that label has done more harm than good. It's created this perception that silver is just a cheaper version of gold, something you buy when you can't afford the yellow metal. But that misses the entire point of why silver matters right now. Silver isn't just a monetary metal anymore, it's an industrial metal trapped in a monetary metal's body. And that dual nature is about to create a problem that no amount of mining can solve fast enough. Think about what's happening in the real economy right now. Not the stock market, not the headlines, but the actual physical economy where things get built. Solar panels, electric vehicles, 5G infrastructure, defense systems, medical equipment. Every single one of these industries is consuming silver at rates we've never seen before. And here's the thing nobody wants to talk about, that silver doesn't come back. When you use silver in a financial transaction, in a coin, in a bar, it stays silver. You can melt it down and reuse it. But when you use silver in a solar panel, in a circuit board, in a medical device, it's gone. It gets dispersed, thrown away, buried in landfills. The industrial demand for silver is destructive demand. It removes silver from the available supply permanently. Now you might be thinking, okay, but they'll just mine more. And that's where the story gets interesting. Silver mining doesn't work the way most people think. Only about 30% of silver comes from primary silver mines. The rest comes as a byproduct of mining other metals, mostly copper, lead, and zinc. So when copper prices are low, when base metal mining slows down, silver production slows down too, even if silver prices are high. Miners can't just flip a switch and produce more silver. It doesn't work that way. And right now, we're seeing mine production flatten while industrial demand keeps climbing. That gap has to be filled from somewhere. For years, that somewhere has been above ground stockpiles. Government reserves, private holdings, recycled silver. But here's what changed recently and why today matters. Those stockpiles are dropping fast. The US Mint has had supply issues. Refineries are running at capacity. Premiums on physical silver have been disconnecting from the paper price in ways that should make everyone pay attention. When you see a spot price of $24, but you have to pay $28 or $29 to actually get physical metal in your hands, that's not a premium. That's the real price. The spot price is becoming a fiction. And this brings us to the elephant in the room that most silver investors either don't understand or don't want to face: the paper silver market. Right now, for every ounce of physical silver that actually exists, there are dozens, maybe hundreds of paper claims on that same ounce. Futures contracts, ETFs, unallocated accounts, digital silver. All of it represents a claim on metal that may or may not actually be there. And as long as everyone's happy holding paper, the system works. But the moment people start asking for physical delivery, the moment they want to convert those paper claims into actual metal, the whole structure becomes fragile. We've seen this movie before with other commodities. We saw it with palladium a few years ago. We saw it with nickel more recently. Markets that looked stable, liquid, deep, suddenly seized up when physical demand overwhelmed paper supply. And silver is far more stretched than any of those markets ever were. The difference is that silver has this monetary component, this safe haven aspect that other industrial metals don't have. So when financial stress hits, when people lose faith in the banking system or the currency, they don't rush to buy copper or nickel. They buy gold and silver, which brings us to what's happening right now in the banking sector. You probably heard about the regional bank issues last year: Silicon Valley Bank, First Republic, Signature. The headlines came and went, and most people moved on. But the underlying problems didn't go away. They just got papered over with new lending facilities and accounting tricks. Banks are still sitting on massive unrealized losses in their bond portfolios. Commercial real estate is still a disaster waiting to fully unfold. And the Federal Reserve is stuck between two impossible choices: keep rates high and watch more banks fail, or cut rates and let inflation roar back. Either path leads to the same place for precious metals. If banks fail, people rush to safety. If inflation comes back, people rush to real assets. Silver benefits either way. But it benefits more than gold in one specific scenario. And that's the scenario a lot of smart money is quietly positioning for right now. If we get a genuine credit crisis, if the banking system seizes up and liquidity disappears, gold will run. But gold is already expensive in nominal terms. Silver, on the other hand, is still trading at prices that seem almost absurd when you look at the supply and demand fundamentals. And that relative cheapness makes it the better speculation for anyone who believes the system is more fragile than it appears. Now let's talk about what January 9th actually represents. Today isn't just a random date. It's the beginning of a period where several major trends converge. We're entering the heart of industrial buying season. Manufacturing ramps up in the first quarter. Solar installations accelerate. Defense contracts get executed. All of that requires physical silver. At the same time, we're seeing increased financial uncertainty. The new administration brings policy changes that markets haven't fully priced in. Tariffs, trade negotiations, geopolitical tensions. Every one of these factors creates volatility, and volatility drives people towards safe haven assets. But there's something else happening under the surface that most retail investors have no visibility into. The big players, the institutions, the sovereign wealth funds, they've been accumulating physical metal quietly for months. Not paper, physical. You don't see this in the headlines because they're not buying through exchanges. They're buying directly from refineries, from mines, through private deals that never hit the public market. And when the big money moves quietly, you should be paying attention. They don't accumulate physical assets unless they're expecting the paper market to disconnect or fail. And here's where it gets really interesting. If you look at the gold to silver ratio right now, it's still historically elevated. For most of modern history, that ratio has averaged somewhere between 50 and 60. Right now, it's hovering above 80. That means silver is cheap relative to gold by historical standards. And when that ratio is stretched, it doesn't stay stretched forever. It snaps back, sometimes violently. The last time we saw a major snapback was in 2011. Silver ran from $18 to nearly $50 in a matter of months. The ratio compressed from over 60 down to 30. And that wasn't because of some fundamental shortage. It was purely momentum, speculation, and fear all hitting at once. Could it happen again? Absolutely. The conditions are arguably better now than they were then. We have more industrial demand. We have less available supply. We have a more fragile financial system. We have more government debt. We have more money printing. Every factor that drove silver higher in the past is amplified today. The only difference is that most people aren't positioned for it yet. They're waiting for confirmation. They're waiting for the breakout. But by the time the breakout is obvious, the easy money is already gone. This is why today matters. Not because something magical happens on January 9th, but because we're at the inflection point where patience ends and urgency begins. If you've been waiting for the perfect entry point, if you've been waiting for more information, if you've been waiting for someone to tell you it's safe, you're playing the wrong game. Markets don't reward safety. They reward early positioning. They reward the people who understand the trend before it becomes obvious. And the trend here is clear. Physical silver is getting harder to source. Premiums are rising. Delivery times are extending. Retail demand is picking up. Industrial demand isn't slowing down. Government stockpiles are depleting. Mine supply is flat. And the paper market is more leveraged than ever. Those aren't opinions. Those are facts. The question is what you do with those facts. Most investors will do nothing. They'll watch. They'll wait. They'll convince themselves they have time. And maybe they do. Maybe silver stays cheap for another year. Maybe the system holds together longer than anyone expects. But if you're wrong, if the trend accelerates, if we get that snapback in the gold to silver ratio or a run on physical metal, you won't get a second chance at these prices. The market doesn't wait for you to feel comfortable. Now let's talk about what this means for the dollar, because you can't understand silver without understanding the currency it's priced in. The US dollar has been the global reserve currency for decades, and that status has given the United States enormous privilege. We can print money and export inflation. We can run massive deficits without immediate consequences. We can weaponize the financial system because everyone needs dollars to trade. But that privilege isn't permanent. It's conditional, and the conditions are changing. Other countries are tired of holding dollars that lose purchasing power. They're tired of being subject to US sanctions and US monetary policy. They're building alternative payment systems. They're trading in their own currencies. They're buying gold. And yes, they're buying silver, not because they think silver is going to the moon next week, but because they want assets that aren't someone else's liability. They want things that can't be printed, can't be frozen, can't be inflated away. And here's the uncomfortable truth. The more the US weaponizes the dollar, the faster the world moves away from it. Every sanction, every freeze, every policy decision that uses the dollar as a tool of coercion makes other nations more determined to find alternatives. And while the dollar isn't going to collapse tomorrow, the trend is undeniable. Demand for dollars is softening. Demand for real assets is rising. And silver sits right at that intersection of real asset and monetary metal. You also have to consider what happens if inflation comes back harder than expected. The Fed spent the last 2 years fighting inflation with rate hikes. They got it down from 9% to 3%, but they didn't get it back to 2%, and they're not going to, because getting it to 2% would require keeping rates high enough for long enough to break something big. And the moment something big breaks, they'll pivot, they'll cut rates, they'll restart QE. They'll do whatever it takes to keep the system functioning. And the moment they do that, inflation expectations shift, bond markets reprice, and hard assets run. Silver runs harder than almost anything else in that scenario because it's cheap, it's accessible, and it has that monetary history that makes people trust it as a store of value. Gold will run too, but gold is already at record highs. Silver has room to catch up. A lot of room. So where does this leave you right now, today, on January 9th? It leaves you with a decision. You can keep waiting for more clarity, more confirmation, more safety. Or you can recognize that the setup is already clear. The fundamentals are already in place. The trends are already moving. And the only question is whether you're positioned before the crowd figures it out or after. Here's what I want you to think about, and drop your answer in the comments, because I'm genuinely curious where people stand on this. Do you think the paper silver market can hold together if physical demand keeps accelerating? Or do you think we're heading for a disconnect where the spot price becomes irrelevant? And the only price that matters is what you actually have to pay to get metal in your hands. Because that's the real question. That's the scenario that changes everything. And if you believe it's possible, even likely, then waiting makes no sense. The wealth continuum isn't about timing the perfect trade. It's about understanding the long-term forces that shape where value flows. And right now, value is flowing out of paper promises and into physical assets, out of trust in institutions and into things you can hold, out of complexity and into simplicity. Silver represents all of that. It's simple, it's physical, it's real, and it's still cheap enough that ordinary people can access it. But that window is closing, not because of some conspiracy, not because of manipulation, but because of basic supply and demand in a world that is consuming more silver than it is producing and printing more currency than it is creating real wealth. The math doesn't work long term. Something has to give. And when it does, the people holding physical metal will be glad they didn't wait for permission. So pay attention to what happens over the next few weeks and months. Watch the premiums, watch the availability, watch how the market responds to stress. And ask yourself if you're positioned for what comes next, or if you're still hoping the old system holds together just a little bit longer. Because hope isn't a strategy. And in markets like these, the cost of being wrong is a lot higher than the cost of being early.